What's up, YouTube? Welcome to the Credit Plug channel, where we talk about how to build credit, how to establish relationships with banks and financial institutions, and most importantly, how to get you access to high limit credit funding. If you're new to our channel or if you've been checking out our content, make sure you hit that subscribe button as well as smash the like button. It really helps our content reach a wider audience, and we greatly appreciate the support. So for today's video, I wanted to talk about business credit. Now, one of the pressing questions that a lot of small business owners might have as they're building up their business credit profile are, what are the data points that lenders and banks use in order to qualify you for a business loan? Now, when it comes to business trade lines, there's two types. You have vendor trade lines and you have financial trade lines. So a vendor trade line is a business to business credit account. Some examples include Home Depot, Sam's Club, Menards, Floor Decor. It's when one business is extending credit to another business, usually like a net 30, net 60. So the other type of business trade line is a financial trade line. So this is when a financial institution, a bank, or a licensed lender is extending credit to a business. Examples of financial trade lines include business loans, business lines of credit, or business credit cards. It's important to understand the types of data points you're building under your business credit profile, whether that's vendor trade lines or financial trade lines, because it will have implications on the types of accounts that you'll ultimately be able to get approved for. So if your goal is to be able to get business loans, you want to focus on building financial trade lines. Now, what I see are business owners building up their vendor trade lines and trying to use that data point to get business loans. You want to focus on financial trade lines. And one of the credit bureaus that you'd want to focus on is PayNet. PayNet is a credit bureau that focuses primarily on financial trade lines. PayNet has a global data warehouse with over 150 different data sources on 118 million businesses worldwide. Ironically, PayNet is actually owned by Equifax, and you'll probably see this a lot where you have some of the larger credit bureaus buying out some of the smaller credit bureaus and third-party data vendors. Now, this gives some of the larger credit bureaus a competitive advantage because they're able to house a lot of different data sources under their umbrella. So aside from Equifax acquiring PayNet, they also acquired another company called Ansonia. So with some of these other third-party data vendors and credit bureaus under their umbrella, it just gives Equifax more information on your business. PayNet has what's called the Master Score. So the Master Score is an algorithm that's used to predict the likeliness of default. And default is defined as businesses that are 90 days or more past due on their credit account. The Master Score algorithm is trained on millions and millions of different financial trade data points. The Master Score algorithm has over 135 different inputs that are used to predict default. There's also different versions of the Master Score based on the industry that the business is in. Master Score version 2 allows lenders to automate and improve their credit decisions while providing predictive abilities that are superior to trade credit data. Benefit to users. So the users in this instance are going to be financial institutions. So the Master Score claims to be able to provide 37.7% fewer losses versus a typical credit score without reducing originations, as well as a 17.7% increase in approvals without increasing default. So basically, they're claiming to be able to provide better predictive ability when it comes to loan default. Master Score version 2 is developed from the largest pool of term debt leases and loans ever compiled to predict 90 days plus past due on a 3-digit scale. So the scores range from 550 to 740. It focuses on many factors in a borrower's profile that are most predictive of repayment. The Master Score version 2 contains a total of 587 variables and 135 unique variables. It was built on a sample size of over 3 million transactions and 135,000 defaults. There's over 29 different scorecards, and all based on borrower industry, size, age, or some combination. All right, so here's a little bit more details about the PayNet Master Score version 2. Now, they were able to develop this algorithm by having a large sample of data, so over 3 million records and 135,000 defaults. Now, I'm not going to break down all the different components of algorithms, but essentially what they're trying to model is the risk of default. And by having this large sample of data, they're able to plug in different inputs. I believe they have about 135 different unique variables that go into this algorithm. And based on those inputs, they're able to predict the likeliness of default. They also have about 400 different economic indicators representing 77 different industries on a state-by-state state basis. PayNet data on borrowers is supplemented with data from external sources. So things like demographic data, the number of employees, revenue, any public filings such as bankruptcies, liens, judgments, as well as trade data. Now, they have some specific scorecards based on the industry. So a couple examples, they have healthcare, professional, transportation, other industries, retail, construction, agriculture, nonprofit, as well as manufacturing. Now, PayNet MasterScore uses 135 crucial drivers that most impact repayment performance. Now, some of those characteristics include payment and delinquency history. You have delinquency patterns. You have a history of serious delinquencies, years in business and years borrowing, defaults and derogatory public records, borrower size, scope, and magnitude, pay down of borrowings, industry and geographic region. So overall, these are predictive characteristics that go into the MasterScore version 2 algorithm to be able to predict the likeliness of default. All right, so let's recap. So you have two types of business trade lines. You have vendor trade lines, you have financial trade lines. Vendor trade lines are business-to-business credit accounts. Financial trade lines are credit accounts that are issued from licensed lenders, banks, and other financial institutions. It includes things like business loans, business credit cards, and business lines of credit. So when applying for various business credit accounts, you want to keep in mind what data points are going to be used in what situation. So if you're looking for vendor accounts, then you might want to focus on building up your Dun & Bradstreet. If you're looking for bank issued accounts, then you might want to build up some of your financial trade lines. One of the bureaus that focuses on financial trade data is going to be PayNet, which is owned by Equifax. Now, again, PayNet has the MasterScore version 2. The MasterScore version 2 uses over 135 different variables to predict a business's likeliness of defaulting on their credit account. Now, here's my overall take on the PayNet MasterScore. Now, this is just one data point. It focuses on financial trade data. So if you're looking to get bank issue types of accounts, you might want to focus on building up financial trades. Now, again, this is just one data source. There's a lot of other data sources, including Experian. You also got Dun & Bradstreet. I mentioned Ansonia earlier in the video. There's Cortera and a handful of other different business credit reporting agencies. You have CreditSafe. Now, since PayNet is owned by Equifax, I would assume that any type of business credit data that's being reported to Equifax will probably somehow make it into the PayNet databases as well. Now, one thing you have to keep in mind is that the PayNet MasterScore is going to be marketed to financial institutions as a way for them to be able to reduce their defaults as well as increase their approval rates. Now, is this going to shake up business lending? I'm not so sure, because at the end of the day, the financial institution would have to be using that particular scoring model to underwrite their loan products. So unless the institution is actually using the MasterScore to underwrite, then that data point actually wouldn't come into play. Anyways, that's all I wanted to cover in today's video. Let me know your comments and questions in the comment section down below. And until next time, y'all take it easy and we'll talk to you soon. Peace.